Hello everybody and welcome to today's podcast, which we have called Budget Opportunities. On the line with me I have Darren Baker-West, who is the Principal of GFM Accountants. G'day Darren, how are you?
Very well, Nick. Thanks for having me on.
Yeah, thank you for taking the time out of your busy schedule, especially this time of year, to share some of your insights around how the budget changes might affect people.
Yeah, look, no dramas at all. We're constantly updating our clients as to where things are at and what impacts the budget is having on them. So more than happy to help out.
That's great, thank you. Now, just quickly, I'll draw everyone's attention to the disclaimer here. What we're doing today is presenting concepts, ideas, talking about things that are in the budget. Some of them are not yet legislated, but it's not. Today's not about giving advice, it's a general discussion, and of course if you wanted to talk specifically about your situation, both Darren and myself will be made available. Okay, a lot of people probably have met me, known me as I've travelled around the country, but my name is Nick Lockhart. We have just clocked into the beginning of our 16th year here at MRD Partners, and I'm married, 4 kids, and yeah, I love helping people plan for their future and get ahead. And as I said, I've got on the line with me Darren. Darren, tell us just very quickly just a little bit about GFM.
GFM Accountants been going for about 45 to 50 years. I came on board in about 1992. Now the principal partner since year 2000. Similar to yourself, Nick, married, 3 children, work pretty hard, and I do really enjoy working with MRD and have done for a long time because they've been a great help for our clients, so that's good. Fantastic.
Well, let's actually get into the guts of what today is all about. We'll touch on some of the things, Darren, that don't specifically relate to property investors, but I'll move through those fairly quickly and we'll try and just focus our attention on the changes that are going to impact those with property. But the Medicare levy tax-free threshold is increasing, which means that some people won't pay the levy who previously paid the levy. Is that correct?
Yeah, look, it's just the threshold that's increased. So basically from the 2017 income year, singles earning under $21,655 will no longer pay the Medicare levy. Those thresholds have just increased slightly, along with families earning under $36,500. They will no longer need to pay that Medicare levy.
And it's proposed that from the 2019-2020 tax year, the actual Medicare levy will be increased by 0.5% to cover the National Disability Insurance Scheme.
Yeah, pretty easy grab from the ATO on this one, but I understand why they need the funding to be able to support that scheme, but 2% to 2.5%, so it's just a 0.5% increase on every basically individual taxpayer earning over that 21,000 and families earning over 36, so they're going to raise a lot of revenue out of that.
Yeah. Hey, one thing that I have meant to ask you, if somebody's salary sacrifices into super, and they're at the top marginal tax rate, would you count the saving, the difference between the 15% going into super and 47.5 cents, or would you count it as being 49.5, soon to become 50 cents as being the saving?
If they're on the highest marginal tax rate, no, it's the 49.5 or whatever it is, including the Medicare levy, that they will be saving, so 100%.
So effectively, once the Medicare levy goes up, people who salary sacrifice into super will be saving 50 cents in the dollar in their own pay packet and then paying 15 cents in the dollar into super.
A slight increase in tax saving, correct, by doing it.
Right. Okay, fantastic. Well, let's move on. Looking at individuals who earn more than $180,000, you're going to pay less tax. That's exciting. Tell us about that one.
A couple of years ago, when the budget was in a substantial deficit, there was just what they call an extra surcharge put on the quasi-rich. So if you earned over $180,000, you're paying a temporary budget repair levy. Now, despite all the reports, it is going to be abolished. So we were of the opinion that they were going to remain, because it was actually supposed to be abolished 12 months ago. But it's staying, sorry, it's going to be removed very shortly, which is a bit of a windfall for all those people. Yes, that's correct.
Yeah. All right, fantastic. Okay, Darren, they've also put into the budget an incentive for older homeowners, that's those aged 65 or older, to downsize their home and take up to $300,000 from the proceeds of the sale and put that into super. So that's an incentive as a non-concessional contribution. What are your thoughts around that?
Yeah, look, it can be seen as an incentive. This is a bit of a wait-and-see approach. The incentive being that by selling or downsizing your home, throwing these proceeds into superannuation, you've effectively put those proceeds into a very tax-effective environment, potentially not paying any tax on the earnings that are derived, depending on your situation. The wait-and-see approach for me right now is whether that $300,000 that's now going into super, and if you're at pension age, will that count towards your asset test, i.e. having an impact on you receiving a pension from the government? So we're still not sure what and how that is going to transpire.
Yeah, so the challenge is we've got all this proposed legislation, and even when it first becomes legislation, it's not until it's tested in the courts, I suppose, and precedent is set that some of these grey areas will be definitively known.
Yeah, I agree with that.
There's a few.
Sorry, I agree with that. The other side of that is that it does open up other options for the government to explore.
Yeah. Yeah. So it'll be a little bit of a wait-and-see approach. Now, with the changed legislation that came through recently that limited a lifetime cap on super contributions up to 1.6 million, as silly as that sounds, yeah, I don't get why they do that, but anyway, 1.6 million lifetime cap on contributions to super. The proceeds from selling the home would contribute toward that 1.6 million if you did put 300,000 in, would it?
Our thought pattern is absolutely it would.
Okay. And these changes will be effective from when?
The 1st of July 2018.
Okay, great. Thanks. Now, foreign and temporary resident homeowners haven't got out of the budget unscathed. The capital gains tax exemption that we all enjoy on our main residence has now been removed from foreigners.
Yeah, even though that slide says access to, that slide should actually say denial of access to the CGT main residence exemption. So basically, if you're a temporary resident or foreign homeowner, you will no longer be able to access the CGT main residence exemption test.
Oh, okay. Yep. Okay. Okay, Darren. So the government is attempting to help first homeowners, and there was a lot of chat before the budget about whether they could use their superannuation as a deposit for a home or not use it. So they've come up with a little bit of a hybrid solution, which is a little bit of yes, you can use your super, but no, you can't. Do you want to just explain to people who are possibly looking to get their first home how this is going to impact them?
Yeah, look, the government are calling it the builder deposit scheme. Basically voluntary super contributions of up to $15,000 per year. So it's after tax contributions. That's called surplus money. And that's only $30,000 in total, can be contributed from the 1st of July 17. This contribution must be within the existing concessional and non-concessional caps. So these contributions can then be withdrawn along with all the associated deemed earnings for a first home deposit. That's from the 1st of July 2018 onwards. The downside or potential downside for this is those contributions and earnings will be taxed at the taxpayer's marginal rate. However, there is a 30% offset attached to any tax that may need to be paid.
Okay, so first homeowners have had some consideration from the government. They're trying to address the housing affordability issue. And before the budget, there was a lot of bantering going around about whether or not they should allow people to use their superannuation for a deposit or not. They've come up with a little bit of a hybrid compromise. Do you want to just explain what's involved with that, please, Darren? First Home Super Saver Scheme, I think they call it.
Yeah, it's called the Builder Deposit Scheme. So what the ATO are trying to get people to do is throw in some proceeds. Let's call your 9.5% that your employer is putting in. They go into their super. They're taxed at 15%. Then trying to encourage first home buyers to then place some additional proceeds into superannuation. Now that's to a maximum of $15,000 per year and a total of $30,000 maximum over that period. Now, what then happens is, if you then get a chance to withdraw those proceeds, your after-tax contributions are tax-free. So when you're receiving that money coming out of your superannuation, you will then be able to place that money against the first home deposit. However, if you're then taking out, let's say, your concessional contributions, which is basically described as your salary sacrifice or your 9.5%, you will be having to pay tax on that withdrawal at your marginal rate. However, there is a 30% tax offset attached to it.
Okay, so what you're saying is any contributions that go into super from 1 July over and above what the employer is contributing, up to the $25,000 cap, it can also be concessional, and the withdrawal of that to use as a deposit is what's taxed at your marginal rate, less 30%. But any contributions you make that are non-concessional, you can withdraw toward the deposit for your home, and those ones are not taxed.
That is 100% correct, Nick. Well done.
Okay, and contributions are from the 1st of July this year, and withdrawals can commence from the 1st of July 2018.
That's right.
All right. Limited to 30,000 in total with a maximum of 15,000 a year.
Correct.
All right. Well, that's would have been nice if they didn't tax anything coming out of super and said we really want to help a first homeowner, but it's still better than just putting the money in the bank, I suppose, and saving it.
Yeah, look, they're getting the tax on the way in because everyone pays their 15% tax on their contributions, and then they're going to, let's call it a slug, the tax on the way out.
Yeah. I read somewhere too that what you can ultimately withdraw is both what you've contributed plus a share of the profit. So, if you've got $100,000 sitting in your super fund and a percentage of that was for the deposit, then that same percentage of the earnings that year can also be withdrawn. Is that correct?
Yeah, it's not just your contributions, less the contributions tax, it's the earnings that have transpired because of those contributions are going in.
All right, fantastic. All right, well, those who have a self-managed superannuation fund often will set up a self-managed super fund because of the opportunity to take advantage of what's called limited recourse borrowing arrangements. Once upon a time, super funds had to pay cash for any assets they purchased, but Howard and Costello introduced some changes about 10 years ago that meant super funds now were in a position where they could borrow to purchase an asset such as a property. The question is that the use of limited recourse borrowing arrangements by your fund is actually included in your $1.6 million total superannuation balance and transfer balance cap, or whatever they call it. It sounds like a mouthful. So can you unpack that a little bit?
Yeah, this has surprised me unbelievably. Let's say you have $1 million in investment/cash, not including property, in your superannuation. If you purchase an $800,000 property, and let's say you have a $400,000 debt on that property. In relation to the $1.6 million test, your debt is ignored. So the gross value of the property is included in that $1.6 million. So on that example that I just gave you, you're actually over the $1.6 million test, and then you'll be paying tax on contributions over and above that.
Right. Okay. So the money you borrowed is deemed as part of the 1.6 million.
Yeah, correct. It's the gross value of the property. They're basically ignoring the borrowing. So you may look at it and say, I purchased an $800,000 property, I owe 400, but my net asset is only 400,000, being the 800 minus the loan.
Yep.
Actually ignore that and include the gross value of the property.
Oh, that's nice of them.
It was a big surprise to us.
So including the limited recourse borrowings as part of the cap, is that a new thing?
Yeah, it is. It absolutely came out of budget night.
Oh, okay. All right. So there are a lot of people probably listening to this podcast now, Darren, who would like to know more about superannuation, setting up a self-managed superannuation fund and so forth. So what we might do is just say, look, if that is you, click on the link in the bottom of your screen right now and let us know, and we'll be in touch with you and we'll set up a time for you to chat, have an initial chat perhaps with me, and if you want to take it a step further, then I'll put you in touch with Darren, and Darren is also able to set up that SMSF for you and look after the whole package.
Yeah, and if I could just add there, Nick, we've been a massive fan of this limited recourse borrowing arrangement since it was first introduced. There are a lot of accountants out there that are anti it, mainly because they haven't been able to explore those options in years gone by. But I've seen clients personally through my practice here take advantage of this, let's call it scheme, that the ATO introduced to basically allow them to buy their first investment property. Without it, they would have been probably not having the equity / borrowing arrangement facilities themselves personally to be able to do such a thing.
Yep. All right. That's great. Thank you. Thank you. Okay, so foreign residents who own property, as in property investors, are going to get slugged with a tax of at least $5,000 if their property isn't occupied for at least 6 months of the year, or at least genuinely made available for tenants. So really what the government is saying is we don't want foreigners buying up our properties and then leaving them empty and creating a housing shortage.
Yeah, look, that's correct, and it's been a trend for quite a number of years, whereby the properties are, let's see, seen as a lot more affordable here in Australia compared to their homeland. So they just acquire and sit, basically don't even rent them out, and they wait for the capital growth to potentially then sell them in the future. So this tax may be a little bit of a deterrent for them.
Now, I don't know if you're aware of this one, Darren, but there is a subtle little thing that's been slipped into the fine print of the budget papers, which basically says that we are all foreigners until proven otherwise. Have you heard of this one?
Oh yeah, this has been around for a little while, but it has been extended. Yes, you actually need to prove, let's say, your resident status when you're acquiring a property.
Yeah, so you need what's called a clearance certificate to prove that you're not a foreign investor, and if you fail to do that, 10% of the purchase price is withheld and given to the tax department. And that used to be, yeah, and that was already applicable on properties that sold for more than $2 million, but now it's been reduced to $750,000. Is that correct?
That is right, mate.
Yeah, I actually hadn't heard of that one before. I learnt something. So if you're listening and you own a home and it's worth more than $750,000 and you intend to sell it at any time, now or in the near future, long distance future, you will need a clearance certificate so as not to pay tax. Right, moving along. Tell us about this one. There's a few property investors who won't be happy about this.
No. For those of you who don't know, I reside in Melbourne. I have investment properties that I've purchased through MRD in Queensland. I enjoy my annual or biannual trip to Queensland to inspect my property, and I'm able to claim my airfare, accommodation, some travel costs, as long as it's the majority purpose of my trip. However, effective 1 July, that would not be allowed as a tax deduction. So any of my travel expenses that I incur, even if I've got a property, let's say 100 kilometres from my house, if I get in my car and drive there to collect the rent once or go and do a few repairs, I'm not going to be able to claim any of those expenses. This is a stinker, Nick.
Mm. You'll be able to claim for the hardware receipts for the repairs, but that's about it.
Yeah, 100% correct. But I want to claim my 200 or 300 kilometres or 400 or 500 kilometres each year.
I agree. All right, now there was a scheme around a few years ago called NRES, the National Rental Affordability Scheme, which is no more. But it looks like they're trying to bring back some sort of a scheme for affordable housing. And the incentive is to give a higher capital gains tax discount when you sell a property under that scheme. Is there anything you want to say there? They're probably not the sort of properties that I'd recommend people invest in anyway.
Yeah, look, it's a 10% extra CGT discount. Housing must be provided to the low to moderate income tenants. Rents, like you said about the NRES scheme, rents being charged at discount rates. And it must be managed through a registered community housing provider. So there's a lot of boxes to tick there to try and get this extra 10% CGT discount.
Yeah. Look, with the National Rental Affordability Scheme, I used to say to people that if the property stacked up on its own and there was an NRES scheme attached to it, that's fantastic. But you wouldn't buy property purely on the basis that there was an incentive from the government. It'd have to stack up on its own.
And that stacking up by its own, obviously, is location and capital growth and all the things that you talk about, mate.
Yeah, exactly. All right, now depreciation. It was funny. I was listening on Budget Night, and they were saying, that the government made very little changes, tinkered at the edges when it came to depreciation. Property investors got out of it unscathed, and all these sorts of things. But flip, it's not how I interpreted it. They removed the depreciation on fixtures and fittings, also known as plant and equipment, on all second-hand investment properties. Talk to me about this one, Darren.
Bit of a nightmare, this one, Nick. We all like getting a tax deduction whereby it doesn't require a cash outlay. So acquiring property, being able to depreciate the fixtures and fittings, the walls, things like that, is always an added advantage for property investors. Unfortunately, post-budget night, you acquire or enter into a contract after that night for a second-hand property, you will no longer be able to claim the depreciation on the fixtures and fittings. You're not seen as the person acquiring those originally. Right. Existing investment property owners, no changes. So if you hold a property prior to budget night, my understanding right now is that there will be no change. So all those people out there listening to this that have an existing property and have held that property prior to budget night this year, no change whatsoever. It's going to impact those acquiring the properties post-budget night.
Okay. All right. Thank you very much. And apparently we're all going to become GST collection agencies from 1 July 2018.
Another, the ATO have had troubles receiving GST off, let's say, property developers or builders. So once I buy the property from them and I pay my GST inclusive price, the ATO then have to try and spend resources, time, effort to try and recover that GST from the developer because they're just not handing over the money. So what they've said now is, too bad, we'll receive it from the person acquiring the property. So the person acquiring the property then has to pay the GST to the government.
So will that just become a standard part of settlement procedures that solicitors will look after?
Basically seen as a disbursement from the solicitor. The solicitor will then, it's like paying the rates to the local council. Yeah, stamp duty, things like that. It'll be seen as a settlement disbursement.
Yeah, so there really should be zero impact on the purchaser themselves.
Correct.
Except it might cost a little bit more for the solicitor to do
to transact something else. That's right.
Yeah. All right. Now, not that this small business tax write-off applies to property investors unless they do own a business, but the $20,000 immediate write-off, which is normally $1,000, has been extended for another 12 months. Is there any area within the Tax Act where a property investor could argue that they are a small business owner because they own an investment property and write off an air conditioner or something in one hit, or they wouldn't buy into that?
Unfortunately, Nick, that's never going to happen. Property investment's seen as a passive investment. You're not actually in small business. You could own 6 rental properties, residential rental properties, and you are not seen as a acting business. So those property people will not be able to access this $20,000 test. The only thing I'll say about this is if those people are in business and they were going to rush out and buy their $6,500 armchair to sit in their office, they now have an extra 12 months to be able to do that.
Right. Okay. Fantastic. So let's just summarise some of these points. The temporary budget repair levy is going to cease, so people earning over $180,000 effectively will be getting a 2% pay rise. There's a 12-month extension on the $20,000 immediate write-off that we just mentioned, but for small businesses only. The Medicare levy will increase from the 2019-20 income year to 2.5%, and the increase is said to support the NDIS. And then there are various measures announced to reduce the pressure on housing. Obviously, the effectiveness of this is yet to be determined. But these include change on foreign owners who are not utilising their properties. They'll be slugged with a vacancy tax effectively. Changes to capital gains tax for foreign investors, including the denial of their main residence exemption. An opportunity for individuals over 65 to sell their home, downsize and drop some cash up to $300,000 into super, but we're yet to be able to confirm whether or not that's going to impact their pension means testing. Denial of any deductions for expenses relating to people inspecting, maintaining or collecting rent for residential investment property. You've got super, no doubt, and your super's growing at whatever rate it's growing, but when we leverage, we can tend to make that more productive. So if you'd like to discuss that, feel free to click the link below and let us know, or any of the other changes such as depreciation or whatever. If you're looking for a great accountant who's pro-property, who understands and who'll help you get the maximum back from the tax department, who'll also help you plan before 30th of June, so he's not just saying, well, this is what your tax bill is, but maybe helped you minimise it while you have the chance, then let us know and we'll put you in touch with Darren as well. Darren, anything you want to add?
How long have I been your accountant now, Nick?
What was that, sorry?
How long have I been your accountant now?
I don't know, what's the time now? At least a couple of hours. No, it was January, or beginning of 2002. So I was introduced to you as someone who was pro-property, good with property, and I thought, oh, he'll do. He's in Melbourne, but he'll do until I can find a decent one local. And
you haven't looked back, mate.
No, gee, it's hard to find decent ones locally.
The other things I'd like to add to what you're saying, Nick, is I just implore people to explore their options. Speak to the likes of MRD and Nick. You do a great job providing advice, guidance to my clients, and obviously a lot more out there. And I do want to add one more thing, just in relation to your travel expenses. If you're thinking of travelling pre-30 June, or in fact no, if you're thinking of travelling post 30 June, pay the expense before 30 June. The tax system is run on such a way that it's a cash-based tax system. So if I'm travelling to Queensland in August and I pay it before 30 June, the changes do not take place until 1 July. So there is a small little window for the next, let's call it 23 days to incur those expenses.
So people can book their accommodation, their airfares this side of the end of the financial year and get a small win.
That is correct, because you've already paid for them. So the tax deduction is deemed to be in place pre-30 June.
Okay. Now, the purpose of today's podcast isn't to talk about ways of reducing tax and saving on tax, but there are a lot of measures. So if you wanted to talk to us about those as well, we're talking about legitimate things that are in the Tax Act, such as prepaying interest on a property, prepaying expenses, salary sacrificing into superannuation, where your limits, both concessional and non-concessional, will change on 1 July. But we've got a client at the moment who is making a very large contribution, or his maximum contribution into super this side of 1 July and then another one the new financial year, because he wants to get his balance in super up to a level where he can look at purchasing property. And of course, if you're wanting to explore the possibilities of using super to buy property, we can do that, but whether or not it's right for you will be determined through a proper advice process. It's not a one-size-fits-all, so I'm certainly not suggesting that everybody should run out there and set up a self-managed superannuation scheme to buy property. It's just not appropriate for everyone. But what Darren said, explore your opportunities and your options. I'm flabbergasted at how many people have no clue what they can do with their super, and aside from the family home, in many instances it's their biggest asset. So thanks for listening. We'll be doing more of these type of podcasts because it seems to be the way people like it. Shoot us your questions. You can email us at office@mrdpartners.com.au or just click the link below and tell us how we can help you. Darren, thank you for your time. It's much appreciated.
Oh, no, thanks for having me, Nick.
And look forward to speaking with you again soon.
All the best.
All right. Thanks. Bye-bye.